What's up everyone, it's me Astan Ali and I warmly welcome all of you on my YouTube channel Forex Talks. Guys, before I discuss about today's topic, I would like to take this opportunity to thank you guys for showing so much love and support to my YouTube channel Forex Talks. We finally have achieved 1k subscribers and now our target is 10k, and I do need your support in order to achieve the 10k target. So for all the members, guys, if you are watching this video or if you are watching any of my video for the very first time, the Forex Talks is about discussing about the trade ideas in the Forex market. We discussed about the forecast of the not only about the Forex currencies but also the commodities and the stock market indices. Therefore, if you guys are interested to learn about the Forex market, or if you guys are interested to learn about the financial information or the macroeconomic indicators, this channel is for you. So click on the subscribe button and also click on the bell icon button, because as soon as I share the daily trade ideas, you are going to get the notification and you will not miss any opportunities in the market. So just click on the subscribe button, and then now let's move on and take a look at the today's topic. Guys, today our point of discussion is going to be the introduction of the Forex market, and I must say that I have designed this particular session specifically for the newbies and for the beginners. So if you guys are having 1, 2 or 3 years or even more years of experience in the Forex market, I will save your time and I will say that this session is not for you. You should refer to the other videos that I have on my channel, which are on the technical side of the market and the fundamental side of the market. This video is only for the newbies and the beginners, or anyone who is not aware about the Forex market and who is looking to learn about the Forex industry. So let's move on and take a look at the video's outline. Guys, these are few things that we would try to cover in today's video. First of all, we will discuss about what is Forex market. In the Forex market, what do we trade, and what are the currency market, how currency market works, and what are the different types of analysis that we perform in order to predict the future of the prices or the future prices, and what determines the exchange rate. Since we are talking about the foreign exchange, the value of currencies vary like every second, every moment. So in this particular video, we will also talk about what determines the exchange rate of different currency pairs. So we are also going to talk about the currency pairs, like there are different types of currency pairs: direct, indirect, and cross currency pairs. You are going to learn about them as well. We will discuss about the terminologies, are the basic concepts about the Forex industry, like which includes like what is core, base, spread currency, what is PEP, and then we are going to talk about the advantages of the Forex market. Lastly, I know that most of the people, like they know about the stock market, but they do not know about the Forex market. So and there are questions about, like one of the most common questions that I have come across in my life is that what is the difference between the stock market and the Forex market. That is why I have included that part as well, so that because I assume that there are going to be questions about like what is the difference between stock market and the Forex market, and how it differentiates with the other markets. So we are also going to cover it. So let's move on and talk about the introduction of the global financial markets. Because the Forex market is a worldwide market of the currencies, and these currencies are known as trading instruments. In the Forex market, we measure the value of one currency for another. For example, the how much USD should cost in euro, and how much USD should cost against the GBP, and how much GBP should cost against the euro. So in this market, we determine the value of one currency for another. Guys, since the globalization, as you know, the whole market has become the single market. There used to be a time when there was a less linkage of one economy with another. But since the globalization, the trade barriers has been removed. So after the removing of the trade barriers, now we are like when one market is getting impacted, the other market is also getting impacted. Which means that if something is going on with China and USA, let's suppose they are in a trade war, this also impacts the other economies. For example, European Union is going to have an impact, the Australian economy is going to have impact, because they are one of the biggest trading partner with China. So which is why if something is going on with the Chinese markets, this is also going to impact the Australian dollar. So which means that if we are like being a trader, we have to know the these kind of fundamentals, and this is all the forex trading is, and that is why it is very interesting to trade in the market. And these are the factors, like for example, as I said, US China trade war, the Brexit event, then we have COVID-19, which is still going on in the market. These are sort of the events which are like which impacts the exchange rate or valuation of one currency against another. So this is what the global financial market is, or the forex market is. Okay, so one of the interesting thing that I would like to share with you guys is that, for example, you must, if I ask you a question, how many of you have been involved in the forex trading? And I think that many of you may say that you guys have never traded in the forex market because you actually have not participated in electronic trading. But the thing is, almost every one of us has participated in the forex industry. We have influenced the forex market, but we are we are not focusing on it, and we are doing it unintentionally, which is why your answer will be probably you have never participated in the forex industry. But the thing is, let's suppose if your brother, your sister, your wife, your father, your mother, if or even yourself, if you are traveling abroad and you are exchanging your currency for the foreign currency, this is what forex trading is all about. The only difference is you are doing it physically in the physical market, in the physical money market, while in this particular like electronic trading, we do it online, like with the help of software, and the objective of this particular trading is to earn profit from the transaction. However, your objective can be different. While if you guys are businessmen, you must be giving quotations to your clients about like how much your product is costing. If you guys are like living in USA and you are quoting to the European client, you will be sending them the European the code in euro, which means that you are participating in the foreign exchange market. Likewise, even when we are chatting with our friends, for example, something is going on between, like this is COVID-19 and then the US-China trade war. While in the gathering with the friends, we also discuss about like how US-China trade war is going to impact Chinese yuan, and how this is going to impact the US dollar, or how this is going to impact the other currencies in the market. When we are discussing about such stuff, we are generating a sentiment in the market. For example, we are sitting in a like cafe, and we are discussing about we are sharing our opinions about the US dollar, and I tell you, or you tell me that the US dollar is likely to get weaker because sooner or later the US-China trade war is going to impact the US economy, and the dollar can get weaker. So which means that in my mind it will be positioned that the dollar can get weaker. With the same sentiment, I will be spreading the words to my other friends, which means that they will also be having a bearish sentiment about the US dollar. So this way we are driving the overall sentiment, overall opinion about the US dollar. So even if you are chatting with your friends about the forex market, this is also participating in the forex market. So with the help of this, everyone will be selling the US dollar because you drove the bearish sentiment in the market. Okay, now let's talk about what forex market actually is. What forex actually is. Guys, forex is an abbreviation of two words, foreign and exchange. When we combine it and when we make it like short, this is forex. So whenever we are exchanging one currency for another, this is called foreign exchange trading, which means that forex trading. So it means that if I am going into the money market, in my local market, I am exchanging US dollar for buying the exchanging with the euro, and my sole objective is that tomorrow, day after tomorrow, or in 10 days, or after 1 month, there is going to be a bullish trend in the euro, and sooner or later I can, like as soon as prices goes up for euro, I will sell the euro, I will exchange it back to the US dollar, and I will try to make money out of it. This is what forex trading is all about. One of the interesting factor about forex market is that this is one of the most traded market in the world. It is even bigger than or even larger than the stock market. Okay, you must have heard about the stock market, and because this is, you know, one of the regulated markets, and every country has their own stock market, and share trading is very common term. People do share trading, but at the same time, the forex market, you won't believe if I say that this is 75 times bigger than the stock market. Overall, the daily trading volume for the forex market is $5.1 trillion. Like, it's an every daily trading volume. And if I compare it with the one of the biggest stock market of the world, which is New York Stock Exchange, their daily trading volume is 75 billion. And I was supposed to say it is 50 times. Like, the forex market is 50 times bigger than the stock market, not the 75 times. Apologies for that. Like, it has like the New York Stock Exchange has a daily turnover of $75 billion, while the forex market has a daily turnover of $5.1 trillion. Why it matters? Let me tell you why it matters. Guys, in the stock market, if the overall trading volume, overall trading turnover is like $75 billion, when we compare it with the forex market, which is $5.1 trillion, the difference comes that in the forex market we do not face liquidity issue, while in the stock market we can face liquidity issue. If there is a bad news about the US economy and you are investing in the New York Stock Exchange, there is a probability that you may not find the appropriate buyers to sell your stocks, which means that the stock prices can dip very sharply. While on the other hand, and due to lack of liquidity and due to lack of trading volume, because people are uncertain about the COVID-19, people are uncertain about the US-China trade war, and people may not be confident about investing in the stock market, which means that the level of liquidity or the level of trading volume is getting down in the stock market. So if you are owning stocks and you want to sell them, there is a probability that you are not going to find the good price or reliable price, because people or the number of traders in the market is falling down. And since we have in the forex market 5.1 trillion average daily trading, there is and people all over the from all over the world are participating in the forex market, and you can trade each and every currency in the forex market. So you never face liquidity issue, you never face due to liquidity. Liquidity means, let me help you understand what is liquidity and why it is important. Guys, liquidity means that how liquid your investment is, how easily you can liquidate or you can convert it into the cash easily, how quickly you can convert it into the cash. It means that if you do not have buyers in the market, and due to lack of buyers, you have to sell them, your bargaining power is going to be lower, while the buyers' bargaining power in the market is going to be higher, which means that you have to listen to them. While on the other hand, in the forex industry, the number of buyers and sellers are going to be, like, as I said, this is the 50 times bigger than the forex, the stock market. So which is why you never face a shortage of buyers and sellers in the market. This market is we often say that the market is not rational, investors are not rational. So every time we have buyers and sellers for a certain currency in the market, because the reason why it is happening, for example, when I'm selling US dollar, my opinion is that the dollar is going to get weaker, while on the other hand, the other person who is purchasing dollar from me is expecting that the dollar has already dropped down, and there is a probability that sooner or later this will rise, which means that this market is the investors in this market are irrational. They have their own opinions, which is why, based upon their opinion, this is very easy to match buyers and sellers in the market. That is why you never face the issue of liquidity in the market. Anyways, with that being said, let's move on, and now let's talk about what do we trade in the forex market. This is one of the most common questions that I have ever encountered in the market, because everyone who have not been a part of the forex market, and they never understand like what do we trade virtually. This is a virtual market. You are not going to get a physical delivery of anything, and this is everything that we trade is visible on the on your trading platform. We will talk about the trading platform in our next session, but anyways, since this is a virtual market, you are not going to get a delivery. How come you can believe that the things that we are trading are real? Let me explain what it is and what we trade in the forex industry. Guys, in the financial market, there's a term called derivatives. Let me come up with the definition of derivatives. This comes from the Wikipedia, by the way. So in finance, derivative is a contract that derives its value from the performance of an underlying entity. That entity can be, that thing can be any asset, that can be interest rate, that can be any other index which influences the prices of the other thing. Let me explain what it is. In case of the crude oil, this is going to be the crude oil is also a derivative. When we trade crude oil in the forex market, this is also a derivative. This is specifically, this is the contract for difference, and we do trade the I will explain contract for difference in the very soon, but the thing is, the crude oil prices are being driven from the demand and supply factor. The demand and supply factor is being impacted by the OPEC decision. The OPEC decision is being impacted by the overall like demand and supply factor. Once again, they decide whether to cut the production or they decide whether to increase the production depending upon what's the demand and existing supply in the market. If there's a lack of demand in the market, they will try to support the crude oil prices. And how do they do that? They decide, they come up with the meeting, all the OPEC member and even the non-OPEC members, which is like OPEC plus, Russia and Saudi Arabia and other Gulf countries come together. They decide the supply, they decide the how much production they have to do for the next month or the upcoming few months in order to support the crude oil prices. So it means that crude oil is a derivative, and its prices are being driven by the demand and supply factors, and the demand and supply factor is being monitored by the OPEC and OPEC plus countries. So this is how we drive this. This is why it is called derivative, because we are driving its prices from certain events or certain entity. Likewise, the precious metal gold is also a derivative, because not only the precious metal gold, but any other currency is also a derivative, because the speaking about the euro, speaking about the US dollar, Canadian dollar, Australian dollar, if their economies are not performing well, the prices are going to collapse. And if their economies are performing well, how do we know whether these are performing well or not? We take a look at their macroeconomic indicators, and if their macroeconomic indicators are performing well, the economies are performing well, so their prices, the trust factor, the demand for their currency is going to rise. People will start investing in their currencies, and eventually, due to a high demand in the market, the prices of the exchange rate of that particular currency is going to rise. So guys, this is something that we trade in the market. These are derivatives. Derivatives have different there are different contracts under the head of derivatives. This can be future contract, forward contracts, swaps as well. We have options, and so these are the different types of derivatives, but we do focus on the future contracts in the forex market. Guys, one thing that you have to keep in mind is that you are not going to get a physical delivery of anything. For example, if you are purchasing the crude oil, if you are investing in the crude oil, or if you are buying the precious metal gold, or if you are investing in the euro, US dollar, you are not going to get the physical delivery of any of the product. So because we are trading the contract for difference, the CFDs, there is a CFD trading in the markets. Now let me explain what is CFD. CFD stands for contract for difference, as you can see here. The contract for difference is basically it's a contract between me and the broker that we are going to settle the agreement broker is going to work as a, there is going to be an agency agreement between me and broker, just like we are giving orders to brokers. Broker is executing my orders based upon my request. So as soon as broker execute the orders in the market based upon my request, this is called agency agreement, because broker is going to charge me a spread or a certain commission in the market. So anyways, there is going to be an agreement between me and my broker, and which means that there is not going to be any physical delivery. Broker is not going to send me products physically, or they are not going to do it they are not going to send me the 1 barrel crude oil with the help of by cargo or by DHL. This is not realistic, and I also do not want the crude oil either. I can't store it. Anyways, there's a CFD agreement between me and broker, which means that whatever I trade in the market, I have to settle it in the whether this is profit or whether this is loss. I have to settle it, and the broker is going to settle the positive or the negative figure in my balance. For example, we have Euro USD here, and let's say I purchase the Euro USD currency at the value of 1.1200, and after some time the prices of Euro USD has soared to 1.1300. It's a difference of 100 pips. If you guys are not aware about the pips, what is pip, don't worry about it. We will discuss about the pips and all the other terminologies which are used in the forex industry in our next video. But for now, you have to understand that 1 pip is equal to $10. Like when we trade with the one whole standard lot, the 1 pip is equal to $10. So which means that if we have 100 pips difference in the price, there is going to be $1,000 in positive or $1,000 in negative. So for example, we took a bullish trade. We requested our broker to execute a buy position on our behalf at the price of 1.1200 level. And as soon as we purchase it, the reason why we requested to purchase at 1.1200 level is that our analysis, after doing analysis, my forecast was that the prices are going to rise for certain reasons. Maybe the macroeconomic indicators of the European economy is performing well, or maybe on the other hand the US economy is going to suffer and the dollar can get weaker, which is why the prices of Euro USD can get stronger. So anyways, after a week or maybe after 2-3 days, whenever it is happening, but the prices of Euro USD went higher to my targeted level of 1.1300, and now there's a difference of 100 pips, and I am requesting my broker to close my position. I don't have to make a call, or I don't have to SMS them. I don't have to send them WhatsApp message. All I have to do is to close my position from the mobile phone or my my trading platform on the system. We will discuss about the trading platforms in the next video, because there is going to be a dedicated video. We will discuss about how to open an account, how to trade with the what are the different trading platforms that we can use on mobile phone and on system as well. Anyways, after I close the position, after the prices rises to 1.13 on my trading platform on my phone, the market will be showing plus $1,000 profit, or maybe if this is against me, this will be showing plus $1,000 negative. So as soon as I request my broker, after I click the close button, this will send a request to my broker, and the broker will close the position. Closing position means that they will sell the Euro USD on my behalf in the market, which I purchased earlier at the price of 1.1200. And after they close the position, after they sell it at 1.1300, the $1,000 which was showing as a profit will be added in my balance. So which means that if my previous balance was 1K, now this will be 2K. So this is what we call contract for difference. The broker will adjust the difference of the buying and selling prices in my balance. So that's how it works actually. Okay, now let's move on and take a look at the next slide. By the way, guys, if you guys have not subscribed to my channel, do it now. And if you are liking the content, do click on the like button as well. Don't forget to click on the bell icon button. Okay, now how do currency market works? Guys, unlike stock market, the stock market has a exchange. There is a New York Stock Exchange. In every country there is going to be a specific exchange which offers the trading desk, and they offer the trading opportunities like in a specific time, like 9 to 5 trading during the office timing, which means that during the US session we can only trade at the specified time in the New York Stock Exchange. While unlike stock market, the forex market is not traded on exchange. It do not have any specific exchange like New York Stock Exchange. This is the over-the-counter market. The buyer and sellers comes together with different means, like it can be with the help of banks, it can be with the help of forex brokers, and this is what we call over-the-counter market. So directly, like buyers and sellers interact. One purchases, the other one sells. Transaction gets completed. That's all. There is not going to be an exchange. This transaction can be done like 24 hours and 5 days a week when we are speaking about the online forex trading. So these over-the-counter market are run by like global networks banks. Like there are different banks which are providing liquidity to the brokers, and they are providing the trading facility to the brokers. They are spread all over the globe. They are from the different sessions. Like we have 4 sessions in the forex market. Number 1 is Sydney session. For me, let's suppose I belong to an Asian country, and for me the Sydney session is going to be the very first one. This is like a start of the day for myself. And then we have a Tokyo session, and after that we have a London session, which is also known as the European session, and after that we have the US session, which means that the market starts from the Sydney session, like and it ends at, for me it ends at the New York session, but right after that the Sydney session starts again. So this is a 24 hours market, and we can trade it 5 days a week. So as I said, this is run by the network of the banks, which comes from the all over the globe. So that is why we do not face any liquidity issue or the trading volume issue or the execution issue. So since there is no central location, we can trade it like 24 hours a day. So that is why it is like one of the biggest market in the world, is because even if you guys are employed full time, you have a full time business, and you are not able to spend like full time job, like you are not able to spend like 7 hours 8 hours a day on this market. Even if you can spend like 2-3 hours, 1 hour a day in the market, 2 hours a day in the market, even then this is for you. You can still trade, you can still take trade opportunities, and this adds up to the liquidity in the market. What I personally like about the forex market is that market offers endless opportunities. Market is always moving. There's always trade opportunities in the market. The Euro USD, the GBP USD, as I said, this is like whole world is involved. Even if I am trading in the Sydney session, doesn't matter, because the market will be moving, because we have Asian investors in the market, and while the Asian investors are sleeping, we switch to the US session, we have US investors. So which is why the trading activity is still going on, buying and selling is going on. When we have the buying and selling activity in the market, there is going to be a fluctuation in the prices of Euro USD and any other currency pair, because we have a demand and we have a supply in the market. So as I said, that the market offer endless opportunities every single day as a result of the constant price movement in the world of the currencies. The only thing that we need to do is to spot that opportunity, and we have to turn them into the profit, which means that I have to spot which currency is going to move at which particular time and from which level to which level. How this is done, I will explain how we can predict that kind of movement in the market. But the thing is, as soon as I can predict it, I will be able to turn it into the profit. So this is what I like about the market. Alright, so moving on towards like what is currency market, guys. In the forex market, currencies are traded in the pairs. Like, what is currency pair? First of all, guys, okay, let's talk about any other market. Whenever we are entering into a business, there is going to be a pair of something. Like, for example, if I want to buy this phone, it is being traded for something else. Like, there used to be a barter system when there was no money involved, which means that if I want to barter this phone for another product, it can be like Samsung phone, so which means that I will just simply exchange it. So but the thing is, there is a pair of something against which I am exchanging it. Likewise, nowadays, if I need to purchase a laptop, I have to pay money. I have to pay US dollar or euro or whatever the currency I need to pay. But the thing is, I have to pay something in the form of money, right? And in return, I will be getting the laptop. Likewise, if I want to purchase an iPhone, I have to pay like 1K, let's suppose $1K, and in return, I will be getting the iPhone. So it means it's a pair. We are selling something and in return we are getting something, which means I am giving US dollar and I am getting the iPhone, or if I am selling the iPhone, I will be getting the US dollar in return. Likewise, in the forex industry, as you know, this is a business and we are in a business of trading. We trade something for another, so we trade like in the currency pairs. Okay, now the currency pairs means that if I want to buy euro, I have to give something in return. That can be US dollar, that can be Swiss franc, that can be any other currency pair. But the thing is, these are traded in terms of pairs. And whenever I am buying euro, I am simultaneously I am selling something else, which can be US dollar. And what determines the exchange rate? First of all, we also have to understand that when I am buying euro USD currency pair, I am always buying the first currency and I am always selling the second currency, which means that when I buy euro US dollar, I am buying euro and I am selling USD. Likewise, when I am selling euro US dollar, I am selling the first currency, which is known as a base currency. By the way, I will explain about the base and code currency in the next slide. But for now, when I am selling euro USD, I am selling euro and I will be getting US dollar in return. Likewise, when we are speaking about the USD Swiss franc CHF, when I am selling USD CHF, I am selling the first currency, which is US dollar, and I will be getting the Swiss franc in return, which means that in the currency pairs, we trade like whenever we are trading, we are buying and selling simultaneously. Okay, now the question is, what determines the exchange rate and how to make profit in the forex market, and how do we know when to buy and when to sell? Let me explain it, guys. In any market, whenever we are making a trading whenever we are making a decision about making a purchase, we do some analysis. We perform analysis. We let me give you an example. If I have to purchase a new car, I will look at the reviews on YouTube. I will compare them with the other cars in the market, and I will also check with my friends which car is better from different perspective. There is going to be different characteristics. Every car has different features, and based upon different features, I need to determine whether this is good value for money. And likewise, if I want to purchase a new phone, I will make a comparison online. I will ask my friends about their experience about that particular phone, and then I will make a purchasing decision. Likewise, in the forex industry, like whenever you have to make an investment, you have to perform analysis, and these analyses are of three different kinds. One is fundamentals analysis, the second one is the technical analysis, and the third one is the sentiment analysis. Now let me explain them one by one very quickly. Okay, I think I do not have a slide of that. Anyways, the fundamental analysis is, guys, whenever I'm trying to predict the future prices based upon the certain event, for example, the US-China trade war, it is very easy to say, like, whenever we have a US-China trade war, whenever we have a like COVID-19 outbreak or the Brexit in the market, it is very, very simple to say, like, very, very easy to understand, that even a layman can understand. It doesn't matter whether you are a financial expert or not, but you will be able to realize that, you know, due to Brexit, the GBP is going to suffer, right? So you are not going to make a purchase of GBP, and due to lack of demand of the GBP, the prices of sterling are going to drop down, right? This is, and since I am forecasting the direction of the GBP, this is what we call fundamentals analysis, because I am doing it based upon some certain event. There is a news in the market, and that's all. Whenever we are trying to predict the future prices based upon some news in the market, or based upon some quantitative and qualitative economic events in the market, that's all. This is called the fundamentals analysis. And then when we try to predict the future prices, there's another method that we can use, is a technical analysis. In the technical analysis, you know, guys, the future prices are dependent upon the past prices. For example, iPhone prices, let's suppose that the first iPhone was started at like $500, then the next iPhone started at like $600, then the prices went higher and higher to 700, 800, 900, and then 1K, then 1.2K, 1.5K, and it is consistently rising. So if I look at the past prices of the iPhone, and there is a next iPhone, let's suppose the Apple company is going to release the next iPhone, I can predict based upon the past prices that the future prices of an iPhone are very much likely to rise, which means that the next iPhone that Apple company is going to release is going to have a higher value in the market. This is going to be a costly phone. The prices will be higher than maybe 1.2K, because the past trend suggests that. Likewise, whenever in the forex industry we are trying to predict the future prices based upon the past prices, this is what we call the technical analysis. There are like several tools that we can use to predict the future prices based upon the technical analysis, but again, this video is all about the introduction, and I don't want to make it very lengthy for you. So I will have like multiple videos or series of videos where we will discuss about the different technical analysis that you can perform to predict the future prices, and with the help of these technical analysis, we can predict the market like with the 75% accuracy, or maybe 80% of the accuracy. By the way, guys, there is never going to be 100% accuracy with the analysis, because, you know, again, this is the forecast, and you can't have a right decision. If you always have a right decision, this is not going to be a forecast anymore. So no one is going to have 100% accuracy. There is a probability of you know, wrong decisions as well, because this market is all about probabilities. We always say that, okay, if that particular price maintains, we are going to suggest a selling position in the market, and if this particular price is going to get violated, then the next target is going to be something else, which means that there is a probability 50% chances if market stays below this, then selling. If market stays above this, then buying. This is what the technical analysis is. Lastly, there is sentiment analysis. If I try to forecast what you guys are thinking of doing with the US dollar in the next week, I will be able to predict the prices, and I will be able to take advantage out of that. How is that possible? If you guys believe that after 2-3 days the dollar is going to get weaker, and if I believe that you guys are going to sell the US dollar maybe tomorrow or day after tomorrow, because there is going to be a negative news from the US economy, and you guys will be threatened and you will be selling your US dollar in the market. So if I forecast it, if I analyze it beforehand, I will be, this is what we call sentiment analysis. I am trying to read your mind, and I am trying to understand what you guys are thinking, and based upon your thinking, based upon your sentiment, you guys will be planning your trades, and collectively this is called sentiment analysis. And if I believe and if I assume that you guys will be making a selling positions, you will be getting rid of the US dollar in 2-3 days, and the prices of dollar will get weaker because of the more supply and less demand, I will perform that trade right now. I will sell the US dollar right now, which means that when the prices fall down, my dollar is not going to, like, I am already out of the market, so this is not going to hurt me. By the way, in the forex market we can short sell. We can take advantage of selling in advance and buying at the low price, which also makes us a profit. We will discuss about it sometime in future. But anyways, now let's quickly discuss about what determines the exchange rate. As I said, the demand of one currency, first currency, and the demand of second currency, supply of second currency. Likewise, the demand of first, second currency and the supply of second currency determines the exchange rate. For example, the first currency, guys, is known as the base currency, and the second currency is known as the code currency. Okay, for example, the Euro USD, the value of the exchange rate of Euro USD is 1.1200, which means that the quotation for Euro USD is the quote price for Euro USD is 1.1200. It means that I have to pay 1.1200 of the second currency, which is the quote currency, to buy the base currency. Whenever you, like, let's suppose I have to purchase a phone, I will ask the supplier to quote me a price, and he will quote me a price that this is 1k USD. So it means that he is quoting me in dollars, I have to pay in dollars. Likewise, if the Euro USD is 1.1200 dollars, which means that I have to pay 1.12 of the quote currency to buy the base currency. So this is how we determine the exchange rate. The supply of US dollar matters, the supply of the euro matters, the demand of the euro matters, and the demand of the US dollar matters. Okay, for example, if something is going wrong with the European economy, their macroeconomic indicators are not performing well, there is Brexit event going on, there's a trade war between the US and China, there's a resignation of the any political party's official, or any prime minister, any president. So any event which is causing chaos in the market, which is causing uncertainty in the market, and people are feeling threatened about that particular economy, and they are uncertain about what is going to happen with that particular economy, they will sell their currency, which means that their supply of that particular currency is going to rise in the market, the demand is falling. Law of demand says that when the demand of something drops down, the prices of that particular commodity, or in that case the prices of that particular currency, are going to drop down. So this is how we determine the exchange rate. If the if the demand of some currency is rising, the exchange rate for that particular currency goes up, and likewise if the the demand is falling down, the exchange rate will also drop down. Okay, so base versus code currency. The base currency is as I said, this is going to be the first currency in the pair, and if this is code currency, the code currency is the second currency in the pair. So for example, we have a GBP USD. The GBP is a base currency because this is a first currency, and that is something that you are going to get when you are buying GBP USD. It means that you believe that today, tomorrow, or day after tomorrow, or in the coming time, the GBP is going to get stronger. That is why you want to buy it. So when you buy it, you will buy GBP USD. So you get the GBP and you sell the US dollar because you believe that maybe dollar is going to stay stable, or this is going to get weaker. This is not getting stronger, right? So so whenever you sell the GBP USD, the objective can be either US dollar is going to get weaker, that is why you are selling this pair, because you are getting rid of USD and you are getting GBP in return. Or the second opinion is that you believe that the UK economy has performed really well while the USD is stable, nothing new from the US economy, so nothing is going to happen with the US dollar. So you are buying GBP USD and you are getting the sterling because of the high performance, the better performance of the economy, and you are getting rid of the US dollar. So this is what we This is what the base currency and the code currency is. Anyways, we have already discussed about this, so I will prefer to move on. Alright guys, so what is bid and ask price and what is spread? Okay guys, the bid price is a price at which you can sell some product. Guys, there is always going to be a difference in the buying price and the selling price. For instance, like in any business, it is not very difficult concept to understand. If I'm running a business of, let's say, I do not have anything else on my side, that is why I'm simply giving you the example of phone. For example, I am in a business of selling the phones. I will purchase the phone at $800 and I will sell it at $150 or $900, which means that there's a difference between the buying price and the selling price, right? The difference between the buying price and selling price is my margin of profit, and in terms of the forex trading, this is called spread. The spread is a profit of the brokerage company, and this is how they earn. You know, they are not going to provide you the services for free. They have to, you know, pay salaries for the support team. They have to pay salaries for the system that they are running. They have fixed costs, they have floating costs, they have, you know, operational costs. So they recover their costs with the help of spread, because this is their profit. Anyways, the difference between the sell price, which is the bid price, and the ask price, which is the buy price, is known as spread. So bid price again is also known as the selling price, and ask price is the known as buying price. And the difference between the as you can see here, the difference between the bid price and the ask price is known as spread. As you can see, there is a difference of 3 pips in the market. This is 98, this is 95. When you buy, you will buy at the higher prices. When you sell, you will sell at the lower prices. And this particular 3 pips difference is basically the profit of the broker. Alright, so now we have the types of currency pairs. Guys, we spoke about, we trade currencies in terms of you know, pairs: Euro USD, Euro against JPY, Euro against GBP, Euro against any other currency pair, or any other currency pair against any other currency pair. But these have some you know, terms or names. For example, we have 3 types of currency pairs. The number 1 is the direct currency pair, number 2 is indirect, and number 3 is cross currency pair. Direct currency pair is the one where we have, let me check if I can use the pen here. Okay, when we have US dollar as a second currency or as a code currency, this is what we call the direct currency pair, which means that the upper currency can be anyone. It can be Euro USD, it can be GBP USD, but the thing is, US dollar here is a second currency. This is what we call direct currency pair. And indirect currency pair is when we have a US dollar as a first currency while any other currency is a second currency. For example, USD JPY, USD, okay, USD CHF, right? So dollar is the first currency here, while the second currency can be any currency. So this is known as a indirect currency pair. The direct currency pair was the one we discussed about. And then we have a cross currency pair. Guys, the cross currency pair is a pair when we do not have a US dollar involved. It can be Euro, JPY, so it can be GBP. Okay, here I think here we have a place, GBP, JPY. So when we have these currency pairs, these are known as the cross currency pairs. Why we need to understand about the direct, indirect, and cross currency pairs? Because the movement of the market depends upon them. The US dollar is, you know, most of the currency pairs have US dollar. That is why if something goes wrong, if something is happening with the US economy, there is going to be a movement in the market. However, if if we are expecting some event from the US economy and we do not want to trade the US dollar, we can trade the cross currency pairs. And since we do not have any US dollar involvement in that particular currency pair, then it means these currency pairs moves totally independent of from the US markets. So for example, in the cross currency pair we have euro and JPY, which means that we have to look at the fundamentals or look at the news which are coming from the European economy as well as from the Japanese economy. Likewise, if we have JPY, we have to keep an eye on the fundamentals coming out from the UK economy, as well as again we have to keep an eye on the fundamentals coming out from the Japanese economy. So which means that if something is going wrong with the US dollar, maybe due to US-China trade war or the tit for tat retaliation between the US and China, or due to COVID-19, because US economy is one of the is at the top number to have most infected people around the globe. So that is definitely causing a threat to the US dollar. People are uncertain whether they need to invest in the US dollar or not. But these cross currency pairs are not going to have any influence of the US economy, which means that you still have a trade opportunity to take. Let me remove this all this drawing, and let's move on and go on the next slide. Okay, so guys, there are the we already covered this one. All right, let me choose the pen again. Okay, so we already discussed about the fact that the direct currency pairs are the one where we have the US dollar in denominator. The US dollar is a striking currency, US dollar is a quote currency, and these are some examples of the direct currency pairs. On the other hand, the indirect currency pairs are the one where USD is the numerator, USD is a first currency, USD is a base currency, and these are some examples of indirect currency pair. And lastly, we have a cross currency pair where US dollar is not involved. Alright, so these are some important currency pairs, like the major pairs with the most these are the one which are mostly traded in the forex market, and that is why the spread of the commission or the spread that we have to pay is the lowest in these currency pairs, because these are the most traded ones. And the minor currency pairs are the cross currency pairs are the Euro GBP, Euro JPY, Canadian dollar JPY, and there are many others. We will discuss about them when we come to the platform section. All right, so now quickly let's take a look at the advantages of forex. Let me take a quick break of 1 minute and then I will join back. Alright guys, so we were speaking about the advantages of the forex market. Guys, one of the biggest advantage that I believe that we have in the forex industry is that forex is a business like any other business in the market. The forex trading is a business where you buy certain currencies, where you sell certain currencies, and your objective is to earn profit. So in order to start any business, even if this is a physical shop, you want to open a petrol pump, you want to set up e-commerce business, whether this is drop shipping, it is very famous, and whether this is any kind of business, you need to have an huge initial investment, as well as you need to have the fixed overall overhead expenses. You need to have a setup cost. If you want to build up a shop or a business or a factory, you have to pay for the land, you have to pay for the building, you have to pay for the labor, and then on the monthly basis, whether you are making profit or not, you have to pay the fixed overhead expenses. You have to pay utility bills, you have to pay the rents, you have to pay the salaries of employees. So the advantage of doing a forex trading is that this is a business. We can start it without having a initial setup cost. We can we do not have to pay any overhead expenses. So whether you are making profit or not, you don't have to worry about the mental stress is at zero level when you know that in this business you do not have to pay any monthly expenses, or you don't have to pay salaries to anyone. So this is one of the biggest advantage. And the second biggest advantage is that this is a 24 hours market, guys. The market continues to offer trade opportunities 24 hours a day and 5 days a week, which means that if you guys are doing any part-time job, or if you guys are doing any particular business which requires 9 to 5 business timings, it's all right. We can still wake up at 6 or wake up at 5 a.m, 6 a.m, 7 a.m, depends upon your capacity. And even after the job timing, we can still perform business activities in the forex industry, since this is a 24 hours market. As it is said, like, never think about entering into a business if you are not willing to spend like up to 12 hours or 12 hours a day in your business, if you are not willing to spend 12 hours of your day into the business activity, then you are not a businessman anymore. So this is why, after spending the 8 hours in a regular job, if you want to join this, you have to spend like 2-3 hours in this market as well, in order to make sure that you are analyzing the market, you are spotting the trade ideas, and you are then executing the trade ideas. Anyways, guys, one of the interesting thing is that, like, once you subscribe to my channel, I will also add you into my personal Telegram channel. And if you guys share your WhatsApp number with me, I will make it work out, like how we can exchange the WhatsApp numbers, because I can send you the I can add you into the group where we have it's a community where we discuss about the trade ideas, as well as we discuss about the daily information about the forex industry, which do impact the market actually. So I will give a link below for the Telegram channel. You can join my channel and you can get the get updated about information about the forex industry, the trading levels, the trade ideas, the hot topics, or the every latest update which is coming out in the market, plus the explanation of how this is going to impact the market. So this is just like a piece of cake on a plate. So yeah, once again, guys, if you have not subscribed to my channel, just do it now, because we are aiming for 10K subscribers and I do need your support. Anyways, guys, this is, as I said, like, it starts from Monday morning in the Australia in the east, and ends at like on Friday afternoon in the New York session. So there is no commission for opening account or the closing account. How do we open the forex trading account? I will explain it in the next video, because this is there is going to be a demonstration. Probably you can also open account along with me, like you can follow these steps. Anyways, I will explain the account opening process. There is no commission involved in it. You if you open or do not open, you don't have to pay anything anyways. So you are own master trading positions. You get to decide how much risk you want to take, how much investment you want to make, and without having any dominance or check and balance of any third person on you. You are boss of your own. You make your own decisions, but again, you have to be mentally strong. You need to know what you are doing. You don't have to invest money in the market which you are not willing to lose, because in every business, I do not sell my I do not like invest money in a business if this is something which I require for my personal needs, and if without that money I can't survive. I will never invest that kind of money in any kind of business, whether this is forex, stock, or any other business. So you are boss of your own. You get to decide what you want to do. So yeah, as we already explained, like it's enormous size brings the endless opportunities with millions of winners every day. It means that the market is trading, market is moving throughout the day, so we have so many opportunities to trade. So guys, account can be opened with zero balance. Like as I said, there is no commission to be charged for account opening. You can have account open, you can have a demo account. Actually, this will be interesting for you. Like in the next video, I will explain about the demo account. You can trade the paper money, you can practice, and then you can get to decide if you want to join the forex industry or not. Anyways, you can even start this business as low as $25. Again, guys, the market is so comprehensive that it is a 24 hours market. This involves all the all the countries, if I am trading with euro USD, it involves two currencies like European economy and the US economy, which means that there is no one regulatory authority which is going to dominate the or which is going to manipulate the prices of anything. Just like in case of stocks, the shareholders have no dominance on the the normal shareholders. The people like you and me do not have any control on the prices, but the the preferred shareholders, the shareholders with most of the shares, like 50% shares, have a dominance on the decision making. So they get to decide whether they want to dump the share prices or whether they want to cause a surge in the prices. However, the price manipulation is possible through insider trading and the stuff like this, but in forex market the price manipulation is totally transparent. This is one thing what I like about the forex market. And the liquidity is actually very huge in the market, which I explained earlier. I will not explain it again, but liquidity, due to like this is a 24 hours market, the whole world can participate in the market, so liquidity is very high. Therefore you can in cash, or you can cash out from the market at a very reasonable price. So profit potential is massive because we trade on the basis of leverage. What is leverage? Leverage is a borrowed money. This is a full-fledged concept. I will explain it in a lot more detail in the next update with the examples, but just for the sake of right now, leverage is something, it is in the financial terms, this is known as the borrowed money, which means that broker gives me borrowed money, broker gives me loan to perform the transaction. For example, if I believe that this phone, once again I'm bringing this, I have to bring this because I have nothing else here. So for example, I believe that this iPhone price is going to surge from 1k to 1.1k, and I have only 1k in my pocket, and this means that if I buy it now and I can sell it in future and I can earn $100 profit. But my broker suggests that Arslan, if you believe that the prices are going to rise, we can give you a leverage, which is a borrowed money, which means that if I was able to buy one iPhone for 1k, now brokers offers me a leverage, and they offer me a loan, and they allow me to buy 10 iPhones for 1k, which means that now my profitability can be multiplied. If I'm right with my analysis, if I was right that the prices of iPhone or prices of Euro USD or the prices of gold are going to rise in future, and instead of making $100 profit, since my trade positions are multiplied, earlier I had one iPhone, now I have 10 iPhones to sell. So if I multiply 10 with the 100, I would make 1k profit. Why? The two things, there are two catches here. Like number one is like, why would broker offer you a loan? Like, they do not know you, why would they allow you the leverage? First thing is, they do it because this is their way to motivate you to invest more in the market, to buy more in the market, because your potential for profit making is higher in this market, in the online market, instead of in the local money market. Because if you go to the local money market, if you have 1k, you can only buy euro worth of 1k, right? You cannot buy euro worth of 1 lakh or 100k. But in the online trading, the broker gives you the benefit of leverage. So that is why people are now moving towards the online trading. This is one of the advantage. Because if you are good with your analysis, and if you believe that the market is moving as per your analysis, then definitely you can multiply your profit. Like, instead of making $100, you were able to make like 1k profit in that particular deal. But on the other hand, if you're wrong with your analysis, it means that instead of losing $100, you are losing 1k. You are losing your full investment in the market. So these are two things that you would know, that I wanted you to know. Now let's talk about the forex market, currency market versus the stock market, guys. The the currency market, stock market are traded on exchange. There's one exchange. Every currency, like in every country, we have the stock exchange, and which is regulated by the the government, the Securities and Exchange Commission. And in order to get our stock registered there, we have to meet like so many regulations we have to meet, so many requirements and there's a timeline to from 9 to 5 there is going to be a trading activity, and after that you can't sell your stock in the market. So one of the biggest example of the exchange is the New York Stock Exchange. As I explained earlier, in the forex industry we do not have any exchange, we have the over-the-counter market. Over-the-counter market is being facilitated by the banks and the brokers, the forex brokers that we are dealing with right now. And the cost of equity is like very less in case of in case of the forex market. The trading stock usually requires the much bigger capital than what you needed in order to trade the forex industry. The reason why it is, as I said, that when you go to the money market physically and you want to invest 1K, you are going to get the trading instruments, you are going to get the stocks worth of 1K, which means that you cannot multiply or magnify your profits. But in contrast, when you invest in the forex market, we get to trade with the help of leverage, which magnifies our trading volume and profits. Again, it can also magnify our losses. We have to keep that in mind as well. Anyways, the cost of equity is very lower. Then there's a leverage, as we already explained. One of the difference between the stock market and the forex market is that the involvement of leverage. Why I believe the forex market is attractive for me is that I have an opportunity to trade with the leverage of 500, while there is no leverage involved in the forex trading. I cannot, if I have 1K, I can only trade with the capacity of 1K, which means that I cannot magnify my profits if market is moving. 100 pips is a big movement that we from that example that we had in the past. 100 pips is a big movement. Mostly market moves like 20 pips, 30 pips, which means that there is going to be a profit of $20, $30, which is not worth of my time. Anyways, if we multiply, if we have a leverage, we have a potential to magnify our profits. This is something which makes forex trading attractive for me, and I think for other traders as well. All right, so now let's talk about the forex. The fourth number. On the fourth number, we have lower spreads on the forex. As I said, there's a huge trading volume involved in the forex industry. This is why due to mass activity in the market, due to abundance of buyers and sellers in the market, the spreads are very tight in the forex industry, while in contrast the spreads are very, very huge in the stock market. That is why I prefer to trade in the forex industry. On the fifth number, we have liquidity difference. Guys, the liquidity difference means that how quickly we can convert our investment into the cash. In case of stock market, as I said earlier, there are going to be limited number of investors in the market at certain time, and especially if we have some crisis going on in the market, just like the US-China trade war, or any other COVID-19, like we have a COVID-19 and the investors were dumping the stocks. So in such situations, we face liquidity issues, and due to liquidity issues, we are not able to get the fair price for our stocks. So that is why I prefer to invest in the forex market, because we have an opportunity to short sell. We can sell it in advance, and we can also sell. We can buy like immediately, and we can also sell anything in advance. Plus, investors from around the globe are able to participate in the market, whether they are from USA or Australia, Canada, or any other region around the globe. They are able to participate, which adds up to the liquidity, which adds up to the buyers and sellers in the market, which means that it is very convenient for me to match the buyer of my currency that I am going to sell. So this makes this market more attractive for me. And lastly, this is one of the most interesting thing, guys. In order to invest in the stock market, you have to be a financial analyst, because you have to the stock prices depends upon the financial reports and their statutory meetings, their annual meetings, and these kind of decisions are going to drive the movement of the stocks. if I'm not a financial expert, I cannot read the financial statement, I will not be able to forecast the prices of the stocks. So which is why I think that this is one of the major reason why people would love to invest in these forex market, because whatever is going on in your economy, you can predict how prices are going to react. For example, you belongs to USA, your government is having issues, your labor market is having issues, your GDP is performing worse than expected, your manufacturing events are not performing up to the mark. So you can simply predict that due to bad economic activity, your currency can get weaker. This is not a rocket science to predict such kind of movements. So this is why we have a huge amount of trading volume, or the investors coming out and coming in and coming out from the market. So this makes this industry, the forex industry, very very attractive, and I believe this is the one of the major difference which drives most of the investors in the forex industry. So guys, I believe that's all for now. And thank you so much. If you guys liked my content, and if you liked my content, first of all, click on the like button, and also click on the subscribe button, and also do click on the bell icon button. Plus I want you to share my video with your friends, maybe on Facebook or maybe on the WhatsApp group, because the more it gets spreaded, I will get the followers, and that's what I want. And do share your feedback about the video. Plus you can also share your feedback about what other topics you would like to learn about. I will try to make a video on them surely. Secondly, if you guys have any question related to forex industry, do not hesitate to post your questions below. I will read all the comments and answer you guys. Plus I will share the link for the Telegram community, which you can join to have a free information about the forex industry. And I believe that's pretty much it. Thank you so much guys for being with me in this video, and I hope to see you guys in the next video. Until then, take care of yourself, stay safe, stay at home, and have a very profitable session ahead. Alright guys, bye bye.